It's been an interesting couple of days for the pound dollar pair. Both central banks, the Federal Reserve and the Bank of England, both having meetings and announcing one, a policy change, and the other opting not to, despite market expectations being for a slight tweak. So we'll start with the Federal Reserve now. Overnight on Wednesday, well, late in the evening on Wednesday here in the UK, early afternoon in the US, the Fed announced that it is going to start tapering its bond purchases by $15 billion per month. That's $10 billion in treasuries and $5 billion in asset-backed securities. That should then, and that will take place immediately from this month, and that should bring an end to their bond buying net purchase program by the middle of next year, paving the way for potential rate hikes moving into later in the year. Now, that was expected by the markets that had been heavily priced in. The question became, when are they going to start raising interest rates? And we didn't really learn an enormous amount from the actual Fed meeting itself. There was a very slight tweak to some of the language that they used, but that was probably just to try and appease some of the hawks on the committee. Still referencing transitory, which I think is important, although slightly tweaking, like say, the language used around the word transitory. So they still believe basically that inflationary pressures are temporary and be caused by temporary factors, but it may be a more prolonged period of higher inflation. Now, in terms of what that means for the outlook for interest rates as far as the central bank is concerned, that was a little bit less clear, and I think we'll probably have to wait till December for that. It was unlikely that they were going to talk too much about raising interest rates after the end of the tapering in the middle of next year, having announced the tapering only yesterday, and also without the benefit of having new economic projections alongside the announcement itself. So I think we didn't really get too much as far as the Federal Reserve is concerned. We got a lot more though from well, in many senses, we got some more from the Bank of England today. The reason why we got a little bit more is because November is the time when we do get the quarterly economic projections. So we get the monetary policy report. So we got more on that sense. But the flip side to that is the Bank of England didn't move. Now, what is so surprising about that is that the language that we've had from various policymakers going into this meeting has very much suggested that interest rate rises are coming. And that usually comes just before the meeting. They're about to make the announcement. And they've been particularly prevalent, I would say, for the Bank of England Governor Andrew Bailey. So the fact that they've decided not to move, and not only not move, but vote 7-2 against raising interest rates by 15 basis points, I think that came as a bit of a surprise for these markets. And that's why we've seen the most movement in this pair today. Now, it is worth noting that we are recording this video after the rate decision, but before the press conference. So of course, there is time for this to change. But the statement that was released alongside the actual decision didn't really suggest it was that close a vote. The one thing that did stand out is that they said they think a rate adjustment is going to be needed at one of the upcoming meetings over the next few months. But again, that's something that the markets had already heavily priced in, and it's kind of the adjustment to that now that we're seeing hitting the pound. The change in interest rates that was expected from a market perspective by the end of the year was around 26 basis points. Obviously, that's not necessarily precise in terms of what the Bank of England would necessarily do, and that's being cut in half in the markets. So that suggests, again, highlights the fact that there's clearly now a view that it's not so straightforward on the committee, despite the hawkish commentary that we have had from certain policymakers, including the governor, in recent months. They did allude to the fact that inflation is expected to be higher, that the unemployment rate is expected to tick up, and they wanted to see what the impact of the end of the furlough scheme was going to have before making this decision. Again, in my view, a bit of a strange statement to make, given that they're not making this decision. They're not looking to raise interest rates up to 1% potentially late next year because the economy is booming. They're doing it because inflation is too high. So again, a bit of a strange comment there in the statement, which may be cleared up during the press conference. But the important thing is what impact this has had on the markets. Now, as you can see from the pound dollar daily chart here, the Fed decision yesterday didn't have too great an impact. We did see the dollar soften slightly, the pound dollar pair tick a little bit higher. Today's decisions had a much bigger impact because the Fed, the Bank of England, was perceived to defy expectations, and we've seen the pound fall off quite considerably in the aftermath of that decision. Like I say, during the press conference, maybe that will change, but at this moment in time, it seems the markets may start to pare back their expectations in terms of what the Bank of England is prepared to actually do. We've pulled back to around 135.50 where we're running into support, but it's quite clear that since that rotation off the 50 fib level, which coincides roughly with the 233 day simple moving average band, it does seem that the pair appears to have potentially peaked here, and that momentum has now picked up to the upside with those with the Bank of England decision today. Now we are seeing support around 135.50. We can see that happened earlier on in October as well, but the key test now is undoubtedly below around that 134 level. That's where we bottomed late September. And that's the next major test of support, I think, for this pair. It's also worth noting that it does look like we've seen support around the kind of 50-61.8 fib level from those late September lows to the October highs as well. So that's probably playing a role as well in terms of where this pair is running into support. But unless Governor Bailey and his colleagues can talk up the potential for more rate hikes now over the coming months, and show that there is more consensus for it as well, based on the vote that we saw today, then we could potentially continue to see the pound come under pressure. Because as I've already alluded to, market expectations were quite aggressive. In fact, there was at one point a view in the markets that we were going to see rates rise almost up to around 1.2% by the end of next year before reversing course slightly, potentially indicating a policy mistake here. So the potential for the downside here is significant, unless, like I say, policymakers during the press conference can convince us otherwise. But the market response so far suggests that they're not expecting that.